Hello and welcome to part 3 of our video blog series, A Dummy's Guide to Smart Beta, here on Sensible Investing TV. Now, the term beta was first introduced by Nobel Laureate William Sharpe in the 1960s. In very simple terms, it denotes the risk of the stock market. But in the intervening half a century, several other risk factors, in addition to market risk, have been identified and quantified. For example, small company stocks and value stocks, in other words, stocks whose price is low compared to other fundamentals, have historically outperformed the market, albeit with a greater level of risk. In 1994, Eugene, Fama and Kenneth French developed the Fama-French Three-Factor Model, which combined market beta with small cap and value beta. Since then, yet more variables have been identified. Here's Garrett Quigley from Global Systematic Investors.
Rather than just focusing on book to market as a measure of value, we also consider additional variables, for example, cash flow based variables that measure how much cash the firm is generating relative to its market cap or the total value of the firm. We also like to use a measure that's looking at whether the company is paying out dividends or whether it's issuing shares. And that is indicative of the degree to which managers may be considering their growth opportunities, but also the cost of capital relating to the firm.
Now, one of the drawbacks with investing in traditional index funds weighted according to market capitalization is that although the value of your portfolio goes up in line with the market, it also follows the market all the way down. And as we saw in our recent series on stock market history, markets can be extremely volatile. Between them, Garrett Quigley and fellow director Bernd Hanke are developing a new smart beta fund which aims to iron out some of that volatility.
Ultimately, the fundamental value of a company is determined by the future cash flows that investors receive in that company. So one should kind of never lose sight of that. So I think as opposed to market weights, it's better to use fundamental measures, accounting-based measures that are as directly related as possible to the expected future cash flows of a company that shareholders receive.
Let's have a closer look at what GSI are trying to do. This is what a cap-weighted portfolio looks like. You'll see the bulk of it's made up by a relatively small number of stocks with large cap weighting. What GSI's model does is to reduce extreme market weights and increase diversification based on other risk factors. The idea is that although you won't do quite as well during market highs, nor will you suffer the lows to the same extent as those relying on cap-weighted funds. Of course, that all sounds very enticing. The prospect of higher returns with reduced risk is the holy grail of investing. But the big question is, does it work? Is smart beta really that smart? And that's the subject of the 4th and final video in this series. Thank you for watching.